what Phil Town and everyone is getting wrong about the recession that is imminent, is always imminent here in the U.S. It's it's just weird. Um, as my man Rob sent me a video from Phil Town, and like I'm not all that familiar with Phil Town. Some other guy I remember probably a year ago now said Phil Town said this. I said I had no idea who Phil Town was. I looked him up, and he seemed all right. I liked him. I had no problem with the guy. It seemed all right. I had no problem with the guy. I'm not here to bash the guy or anything like that. But he did a thing on the recessions and whatnot, and I just it's interesting because if you don't expand your horizon and only look to the U.S. For validation of economics, then you can fall for the trap that this is what happens for recession. But you got to expand your horizons, and I think a lot of people don't because they just look at the U.S. because that's what they know. That's what they know. And so I'm just going to recommend again this book, The Holy Grail of Macroeconomics, Lessons from Japan's Great Recession. And I'm going to share with you what Phil Town and others, seem like everybody, get wrong about the recessions, because this is not like any other time. It's not. It's actually the model for Japan is incredibly insightful. And for those of you who are history buffs or economics folks or even just investors, you should read this because A, it's an easy book to read, but B, it's incredibly informative, and it will tell you some ideas of what to expect, because this is what I think we're going into, and it's stunning to me. It's stunning to me because I remember 10 years ago, my friend Rich and I were doing seminars all up and down the East Coast on behalf of USAA. And Rich was talking about we're looking at deflationary time, not unlike Japan. I said, dude, you're nuts. Inflation is always and everywhere caused by monetary policy. That's what Milton Friedman said. So it's always going to be inflationary. 10 years hence, we haven't had it. We just haven't had it, and it's insane how right he was and how wrong I was. And it's only going to get worse. And this is why this book is must read for you, because I'm going to share with you some tidbits of it. But it's nuts. It's nuts what we're going through, and no one knows unless you understand Japan what this means in the future. And I don't even know what it means in the future, even if you do understand Japan. I don't, but at least Japan can give us the premise of where to hang your hat on, as opposed to just the typical U.S. dictates of recessions and growth and stagnations and things of that nature. I mean, because we're in uncharted waters for the U.S. Has anyone ever asked? Maybe the Fed has too much power. I mean, I know Austrian School of Economics has, and I completely agree with that. The Fed doesn't know any more than you and I, and why we act like the Fed. I don't care who it is: Greenspan, Janet Yellen, Powell. Bernanke. Bernanke. Volcker is the only guy who did anything righteous with the Fed, and even but maybe that's luck more than insight. I don't know, but the Fed's got too much power. I mean, the idea that the Fed can do this and pull this string and tighten that, it's not working. It's not working. Can we just admit it's not working? It's like my man Leonard Reed says that once you get accustomed to the government doing this, and I get the Fed's not the government, it's okay. But once you get accustomed to the authorities doing it, you think that only the authorities can do it. Has the Fed have they actually minimized the recessions, deflations, inflations, depressions, and all that since they've taken power? I mean, they've only been around since 1912? 100 years, and we've had mass ups and downs in the economy, massive amounts, because of Fed's ineptitude. Can we just say, let's get rid of the Fed once and for all? I mean, this is nuts. But before the Fed, we had all this, in the 1870s, they had mass up and down too. There's a business cycle, but the Fed hasn't done anything to stem that. All right, or I guess arrest that, I should say. I mean, they're allowing people to take untold risk because they think the Fed is going to rescue them out. It's nuts, and the Fed doesn't know. All right, so let's go into a little bit of this because I think it's incredibly informative. So I'm going to start with this chart, and you won't be able to see this, but I'm going to read it to you. And basically, structural problems cannot explain Japan's economic malaise. And so basically what they're doing is they're comparing the U.S. during the Reagan era, so when Reagan took office in 1980 versus Japan during the mid-90s. And so they're saying short-term interest rates in Japan is 0, and Reagan is 22%. Long-term interest rates in Japan is about 1.5. In Reagan's era is 14. So talk about inverted yield curve right there. So Reagan had 22% on the short, 14% on the long. Japan had 0 on the short and 1.5% on the long. No inflated inverted yield curve, and yet Japan was still in a recession. So does the inverted yield curve then? Can we just throw that out the window once and for all? Because Japan didn't have the inverted yield curve, and yet it was recessionary. Home mortgage rates in Japan was between 3 and 4, and the U.S. is 17%. Labor issues, there were none in Japan, and then the frequent strikes during Reagan's time. Japan was in deflation, where the U.S. was in double-digit inflation. Balance of trade, well, Japan had the world's largest surplus. The U.S. had deficits, big deficits. Exchange rate, massive intervention to stem the yen's rise, trying to stop it from continuing to go up. And the exchange rate in the U.S. was falling sharply. Basic economic conditions of Japan. Adequate supply, but not enough demand. I'll get into that here in just a second. Adequate demand, but not enough supply for the Reagan era. So we're looking, so two completely different things here. Reagan was supply side is what fixed it once and for all. Reagan's supply side economics fixed it without question. But to do the same thing in Japan when there's already enough supply, and I'll bear with me just a second, we'll go into that, would be silly because Japan doesn't have a supply side issue. They have a demand side. All right. So let's I'm just going to read some of this stuff here. And so what my man Richard Koo says is Japan did not recover because banking sector problems were fixed. And so what happened in the U.S., we recovered because essentially Paul Volcker said we've got to stem the inflation. We've got to do that. Cut taxes, stem the inflation, supply side economics, and next thing you know, the dollar is getting stronger. Dollar is getting stronger. Their interest rates are going down. The unemployment rate was dropping. We had tax cuts, increasing more and more income into the economy, and all this stuff. Which would you think tax cuts would lead to more inflationary? It just did not, because people were able to use that money because they're having a problem with the supply side cash flow. All right. So since 2002, the aggregate value of bonds has been steadily declining in Japan. In other words, redemptions have exceeded new issuance. Ordinarily, this scenario would be unthinkable with interest rates at 0. Even if we allow the argument that banks for some reason refuse to lend to their corporate customers. And that's what Phil Tano was saying, that banks are refusing to lend to their corporate customers. The idea is that the Feds are going to raise rates, it's going to cut the flow of lending, and the flow of lending is going to cause a recession because banks don't have the credit lines to have access to, and because they can't raise capital, they can't grow, they can't even pay their debt they already have. Higher interest rates means more cash flow to pay off the interest that they've already, or the debt they've already incurred, and that's going to lead to cutbacks. And that's the typical recessionary mantra of basic macroeconomics in the U.S. Look, man, the basic mantra has been disproven time and time again. Just look at something called the Phillips curve. High unemployment leads to high inflation. And I mean, how long have we been now with high unemployment? I mean, not high employment. So low unemployment, excuse me. Low unemployment leads to inflation. How long have we had low unemployment and we haven't had inflation at all? We're going back to George W. Bush times. Low unemployment and high inflation hasn't happened. It's been low unemployment and low inflation. In fact, even under Clinton, I mean, we're going back decades now. And so the Phillips curve that says low unemployment will lead to high inflation. We just haven't had it. So we can throw that macroeconomics tool out, but they don't, because economics under the Samuelson model and stuff, they want to have these graphs and numbers and econometrics to prove how smart they are. And it doesn't work in reality. So again, ordinarily, the scenario would be unthinkable with interest rates at 0, that the value of bonds would be declining. Even if we allow the argument that banks for some reason refuse to lend to the corporate customers, the companies themselves make the decision of whether to issue bonds. If firms sought to raise funds, we should have witnessed a steep rise in the amount of outstanding corporate bonds. In the event, however, the outstanding of such debt fell sharply. So what they're saying is, even if banks cut off the lending valve, so to speak, the spigot, the companies could still say, okay, the banks aren't going to lend, but we're going to raise money other ways by issuing debt. They didn't do that. All right, so now we're going to talk about the Japan's experience was the opposite of that in the U.S. during the 1990s credit crunch. So let's go into this. The government bank inspectors rushed to examine the health of commercial banks. Using the most stringent interpretation of the regulations, the regulators argued that many institutions were undercapitalized, thereby making the nationwide credit squeeze that lasted from 1991 to 1993. That's what happened in the U.S. They undercapitalized because of the S&L crisis, the leveraged buyout stuff, and they said, the banks are undercapitalized, so we're going to squeeze the banks to make sure they don't make loans. So that's exactly what happened. And this is back in the U.S. now. So we're using two completely different things. Japan, there wasn't a credit squeeze at all. Banks or companies weren't needing cash from the bank. Instead, they were paying down their debt. In the U.S., though, faced with the reduced availability of credit, listed companies in the U.S. turned to the bond market because, remember, they did turn off the spigot for banks because the bank regulators said because of the S&L crisis and the leveraged buyout stuff that we've got to close the capital. The banks are undercapitalized, and that's why the S&Ls went kaput because the banks theoretically were undercapitalized. So we're going to increase the capitalization requirements of banks. Banks said we're not going to be able to loan anymore unless you have more and more capital, which is exactly what happened in 2008. I share with you my story of my man Joe, who had car wash facilities. His loans were performing. But the bank said the regulator said the banks were. My nose itches, man. I just got to have a hot shower because apparently, if you take a hot shower, it stems your craving for sweets. So we'll see. So for some reason, my nose is itching. Anyway, so in 2008, my man Joe had a car wash companies paying off like crazy. He was making money. The banks were getting paid. But the regulators said, the banks are undercapitalized. We need to raise equity. So they called Joe and said, man, we need you to give us a check for $300,000. And Joe says, I don't got that kind of money. So the bank had to call in the loan. And the loan went kaput. It went bankrupt. Joe went bankrupt. And the bank was sitting on 5 or 6 car wash things that were just literally growing weeds. No one was building them. No one was using them. So they had to write off the loan, and they weren't making cash flow. They had this property that then they had to sell for pennies on the dollar later on. I mean, it's insane. But that's the Fed. The Fed is so smart. We have the same issue in 1990 to 1993. Is that the bank said, or the regulator said the banks, you were undercapitalized, so the banks had to call loans in. This is typical of the U.S. recession, which is what Phil Town talks about, which I agree with. The problem is that's not where we are today. All right, so faced with reduced availability for credit, listed companies in the U.S. turned to the bond market, triggering a boom in corporate bond issuance. This is nuts. So basically, again, I cannot stress this enough. The bond market, because just unlike Japan, so let's go back to what he said about Japan. If firms sought to raise funds, we should have witnessed a steep rise in the amount of outstanding corporate bond issuance because theoretically the banks were turning off the spigot in Japan. That's not what happened. If the bank was the cause of recession of Japan, the banking industry, the regulatory environment, and they turn off the spigot of lending money to firms, then firms should have gone to the bond market to issue debt. They did not do that. In America, they did. In 1990 to 1993, they turned off the spigot to lend, and so the firms went to the bond market to issue debt, to raise funds. And this is interesting. Japanese lenders were naturally among the foreign banks that benefited from the surge of U.S. corporations going to the bond market. At the time, this is Richard Koo, at that time I was working in Tokyo. I often received calls from high school and university classmates who are now serving as corporate treasurers at U.S. companies and were in Tokyo on business. When I asked what they were doing in Japan, they told me that their U.S. banks had cut their firm's credit lines and that they were here to arrange replacement lines with local Japanese banks. During the past 15 years, however, hardly any Japanese company representatives were traveling to New York, Hong Kong, or Taipei in search of banks that would provide a yen credit line. It would have been easy enough for Japanese executives to travel 3 hours to Taipei to arrange one with a Taiwanese bank at almost the same rate they're paying in Japan, but none did. Why? Because they weren't looking to borrow money. Oh, man. Crazy. All right, turning to the third phenomenon, bank lending rates. The U.S. economy was in such dire straits in 1991 that Fed Chairman Alan Greenspan lowered the federal funds rate to 3%. But banks were unable to lend because they lacked capital, and this capital deficiency would not change no matter how much the central bank lowered short-term rates. With so many companies seeking to borrow, competition for the limited funds drove up prime lending rates to 6%. This enabled banks to pocket a 3 to 4% spread over their 3% cost of funds. Greenspan called this the fat spread, and he allowed it to persist for years. So essentially, Greenspan is saying, look, we need to get more money out there. We're only going to charge the banks the federal funds rate 3%. Now, because the bank said, okay, we're going to borrow from the Fed window at 3%, and we're going to turn around because there's so many companies desperate for money that the banks could charge higher and higher interest rate. High demand equals higher rates. That's all there is to it. Or higher prices in this case. So higher price, the bank says, all right, I'm competing with Joe, I'm competing with Mary, I'm competing with Sam, I'm competing with Tim. All you guys want my money? We're going to have higher, more strict underwriting, and we're going to charge you higher rates because there's such a demand for our money. So we're going to loan it to you at 6% while we're going to turn around and borrowing from the Fed at 3%. It's a freaking great scheme. It's a great scheme for banks in that case. And yet, so Tim, the corporate guy said, I need that line of credit. I'll do whatever I can. But then going back to what my man Richard says, Japanese lenders were naturally among the foreign banks that were benefiting from the credit line surge, because they're saying, look, if I got to pay Bank of America 8%, maybe I can go to Bank of Japan and pay them 7%. And Richard said, I saw all these guys from America companies in Tokyo looking to borrow because they're getting killed on the rates of the U.S. All right. So, Japanese experienced a balance sheet recession in the 90s. If Japan's fundamental problem was neither structural nor banking related, was it caused by monetary policy mistakes, as many academics have explained, or claimed, I should say. So, Japan's fundamental problem was neither structural nor banking, i.e. structural would be they didn't have labor strife, they didn't have high interest rates, the whole thing. And it wasn't banking. Banks were able, eager, willing to lend. So what caused the recession? And here's where it gets interesting. All right, it's actually funny too. So it'd be let me read this. Oh man. All right, so here, let's just read this because this is answered. It's phenomenally awesome. To answer this question, one must look at a peculiar monetary phenomenon of the Japanese economy that is not discussed in any textbook. Some readers may think this claim is exaggerated, but Japanese firms have spent the last 12 years paying down debt when interest rates were 0. One could scour the economics departments of universities and the business schools of the world and not find a single one teaching that companies should pay down debt at a time when money is essentially free to borrow. The reason they don't teach this is simple. According to conventional economic thinking, a company that is paying down debt at a time of 0 interest rates is a company that cannot find a good use for money, even when the cost of funds is 0. And I'm going to show you how this relates to Japan and what could be here. Such a firm, which has no reason to remain in business, should fold up shop and return the money to its shareholders. After all, companies exist because they are better at making money than other entities. This intellectual framework, though, does not allow for an enterprise that refuses to borrow, much less one that seeks to liquidate existing debt when interest rates and inflation rates are both at 0. This is why no business school textbook contains such a case study. But from about 1995, Japanese companies not only stopped taking out loans, they actually paid back existing ones despite interest rates being near 0. When companies that should be raising funds to expand their operations stop doing so en masse and instead begin paying down existing debt, the company loses demand in 2 ways. Businesses are not reinvesting their cash flow, and the corporate sector is no longer borrowing and spending the savings generated by the housing sector. This contraction in aggregate demand causes the economy to fall in recession. So before the U.S., we had a supply. We didn't have enough supply lending. We didn't have enough lending going on to allow. I just had a thing. I was like, whoa. They did not have enough supply. It was a supply side problem, and we had to fix it by allowing more and more lending to lower the stringency on the lending that American corporations can do. And Japan is the exact opposite, a mirrored image. It's a demand side. They're saying, look, you can lower interest rates all day long. We are not going to borrow. We are not going to borrow. In fact, not only are we not going to borrow, we're going to pay down existing debt. Why then did businesses, which under ordinary circumstances should seek to borrow money when interest rates are low, move to pay down debt despite interest rates at or approaching zero? The answer is that the Japanese asset prices plunged in a most devastating manner for more than a decade, destroying millions of corporate balance sheets in the process. Exhibit 1.4 plots the price of commercial real estate in Japan's 6 largest cities, the TOPIX stock market, and the price of golf club memberships. The exhibit showed that stock prices, which were buoyed by foreign investors, fell only 54%. This is as of 2008 from their peak. The other two assets, which failed to attract foreign interest, at least until recently, he had written this in the end of 2009, suffered much steeper decline. So it's going to be tough to see that. I was looking for this I could post it as an image, but basically what's happening is the TOPIX is this guy right here, and that fell 54% over the course of from 1988 till 2007. 20 years that sucker was down, 54%. What happened to the price of a golf club membership? It fell 93%. And commercial land prices in 6 major cities fell 83%. Commercial, this is down here, 83%. That's over 20 years, man. Ay, ay, ay. Although many members of the foreign media held a field day bashing Japanese management as a cause of Japanese economic ills, foreign investors were responsible for more than half of the net purchases of Japanese equities during the past 15 years. But here's the problem. So basically the Japanese stock index only fell 54% because foreign investors were responsible for more than half of the purchases of Japanese stocks. But it was a different story in markets in which foreign investors did not enter. Golf club membership and commercial real estate had fallen 95 and 83% respectively, leaving them at about 1/10 of their foreign value. So foreign people aren't buying golf club memberships in Japan, and they're not buying real estate in Japan either. When the value of properties collapsed, but the loans used to buy them or their loans obtained by using those properties as collateral remained, companies all over Japan suddenly found that they not only lost a lot of wealth, but their balance sheets were way underwater. A business that had acquired land valued at 10 billion yen might have found itself with a land worth 1 billion yen and a residual loan balance of 7 billion yen. In other words, this asset liability pair suddenly had a negative net worth of $6 billion, opening up a large hole in the balance sheet. Crazy. And he talks about how the company was doing just fine, but the balance sheet was well underwater, and that's not good. And he talks about it. In other words, core operations of these Japanese firms were healthy. Cash flow was robust. Companies were generating profits. Yet many of these firms had negative net worth because of the huge hole left by their balance sheets and the plunge in domestic asset prices. Thousands, even perhaps tens of thousands of firms fell into this category. Whether Japanese, American, German, or Taiwanese, the manager of a firm with a healthy balance sheet and positive cash flow, but a deeply troubled balance sheet, regardless of Japanese, American, German, Taiwanese, the manager of the firm with a healthy business, and positive cash flow, but a deeply troubled balance sheet would respond in the same way. He or she would use cash flow to pay down debt as quickly as possible. Because assets cannot assume a negative value, a firm's debt overhang will eventually disappear as long as it continues to reduce the liability. At that point, the business will return to the profit maximizing mode assumed by the economic textbooks. But no economic textbook had a firm generating a healthy business with wonderful cash flow that had huge negative balance sheet. None has that. So basically, the first priority for a business in that case is no longer profit maximization, which is what the textbooks say, but debt minimization. And as long as the business is generating cash, it can repay its loans. This is freaking nuts. The urgency of the debt repayment in Japan was heightened further by the fact that Japanese firms of the late 80s were much more highly leveraged than U.S. or European counterparts. They had high leverage because their growth rates were so high in the 80s. The value of the assets they bought with borrowed funds kept appreciating before the bubble burst. Something huge to learn there. So, I mean, and that's the problem with leverage. Something huge to appreciate there. Leverage will bankrupt you eventually. It's just no getting around that. At some point, you will go bankrupt because of leverage. What do you have in your home? You're leveraged to the hilt. So essentially, it's the same kind of thing of saying, why would you pay down housing debt? And the funny thing is, if you say, well, because I think about this too. I said, I can get cheap money, 0%, credit card, balance transfers. You can get 0% money. And you could turn around and put that money into a performing asset like a stock. But if you go back to this chart right here, 20 years, my friends, 20 years of the stocks in the Japan just going from here and just flowing and not doing anything. And I think the Nikkei is back up. I think it's not much, but I think it's up. I forgot what the topics was, but here in this 2019, they were both up a little bit, relatively speaking, but not much. It's nuts. Even I think the last 20 years, they've averaged like a 3% rate of return. So here we are today in the U.S. How does this affect us? Forget the stupid recession stuff. At the end of the day, we have assets that are we've seen what leverage can do. So you're saying, okay, leverage can swamp you, as seen by Japan. We've just seen it by LTCM. It's time and time and time again. Seen by farmers in the Great Depression. Time and time again, leverage can bankrupt you. And the point is, you take the leveraged money, the borrowed money. Let's just say a 0% credit card balance transfer. You say, I'm paying nothing in cash to that credit card. So nothing in interest to that credit card. I got to pay cash. I get that, but I'm paying nothing. So I'm going to borrow against that credit card and turn around and put it in a stock because I think the stock market will give me a 6 or 7% rate of return. Well, if you would have done that in Japan, it would have taken 20 years. And even then, you still haven't recouped. You're still underwater. So now you're, $20,000 you borrowed against your Navy Federal credit card at 0% for his life of the loan. We'll just say for the life of the loan, you're going to put that in stock, and now it falls 54%. And even here it did too in 2007 to 2009. Now it's worth $9,000. Now you're not paying any money for that debt, right? But you are paying a cash flow. And you can't just turn around and sell that stock you have because it's worth $9,000 when you have a $20,000 liability against it. You're doomed. And the same thing happens on a home. Let's say you borrow against your home, 5%. 95 to 5% leverage. I mean, you're basically for every 100,000 you're borrowing, you're putting 5,000 in. Does a home have to appreciate? No, we've seen this happen, man. No. And so when it doesn't appreciate and you got no equity, you're doomed, especially if you lose your job. So going back to Phil Town and stuff, yeah, the old economics textbooks of recession said they're going to turn off the spigot to lend, but that's not a problem now. Banks are flush with cash, flush. The corporate bond market is flush with opportunity. Any bank, any company can say, I'm going out there and I'm going to give you 3% debt for 20 years. But very fewer and fewer people want to take on that because they see, I don't know if they do it deliberately or not, but they see what's going on in Japan. And they said, that didn't work even then. So what I'm going to do is I don't trust the markets. The markets are highly valued in terms of price to earnings, relatively speaking. So I think it's too high. The bond market is incredibly highly valued. That's why I can only get 1.5% on a U.S. Treasury 10-year debt. So I think I'll eschew that. It doesn't make any sense for me to leverage my own resources when I can just pay down my own debt or keep my cash on the side until I can invest it at a better rate of return. This is not a typical recession. This is a balance sheet recession, just like Japan happened. And when you have a balance sheet recession, you got to pay down your debt, man. It's all there is to it. You got to pay down your debt. I'm telling you. Now, look, do I still invest in stocks? Absolutely. Absolutely. But because I do think at the end of the day, earnings are growing, cash flow is being paid, dividends are being paid for sure. We are not Japan. We are a more dynamic economy than Japanese. But I don't think you should leverage to invest in stocks. No way. Should you leverage to buy your home? Sure. You have to. There's no other way around that. But should you leverage to invest in stocks? No, you shouldn't leverage at all. You should just say, look, I think at the end of the day, but don't forget the Japanese corporations were doing just fine. They were making payroll, they're making cash flow, they're paying dividends. They were fine. It was just their balance sheet had taken on the chin because the complete drop in the asset prices. Could that happen here? Sure, absolutely. It could, and if it does, it sucks for folks who are invested, but it'll kill you if you're leveraged to be invested. Anyway, I hope this helps. I tell you, man, this is the fundamental book you need. Again, the holy grail of macroeconomics. I just, whoever sent this to me, you are the man. I hope you tell me who you are, because I'll send you a free copy of my book for sure. Because this is it's critical to understand. All right, don't forget to smash. We'll see you guys next time.